Hi, welcome to this week's Stockscores Market Minutes. Pretty good volatility in the market this week, something that began back in June. And if you go watch my videos back then, you'll know that we discussed how this was likely coming. So the next question is this weakness really an indication of recession? I've seen a lot of doomsayers on the internet saying that a recession is coming for the United States. And this weakness in the market is perhaps the first step toward that. So I'm going to show you how to know when a recession is coming and also whether there is more weakness in this stock market crash. Plus, I'm going to walk you through the different indexes we always look at. We're going to look at what the bond market is predicting for stocks and try to give you some sense of where the market is going. And then at the end of the video, I'm going to show you a swing trading strategy that yielded great results on a stock SERV, really strong gains in that, why we bought it, and where that stock might be going next. But let's get right into it and talk about whether the stock market is crashing, whether this is a recession. So typically, when markets bottom or when markets crash, they usually do so by a certain pattern. They will make a new high, then they will break down, they'll make a falling top on they'll have a little rally, make a falling top, and then break down further. I'm going to show you this on a chart in just a moment. So when that happens, that's a reversal pattern for a topping of the stock market. It happened in NVIDIA, which is why that stock has gone down a lot. And NVIDIA and some of those other large cap tech stocks, as I've discussed in recent weeks here, are one of the main reasons why this market is showing weakness. In fact, it's really a tale of two markets because we have large cap tech very weak, and I told you it was going to happen. Go back and watch the videos, make sure you're subscribed to the channel so you can always get these updates. But also, we're seeing now money flowing into the broader market, but in the last couple of days, we've even seen the broader market pull back. Why does that happen? Well, when investors look at the market and they see the Dow down 600 points, they get nervous and some of them just sell everything thinking that a big crash is coming. So we're going to look at the charts in just a moment and I'll show you how that's playing out. And this is a chart of the S&P 500. This is a daily chart. So we have this upward trend line, hitting new high, broke it. That's step one. Build of a falling top and then breaking that upward trend line. That's step two, pointing to more weakness ahead. Now this is the daily time frame, which is not really the conclusive one for a major stock market crash or a major recession for that matter. Let's look to the 3-year weekly chart. And there you can see that the weekly chart is coming off of this high, just like as it did here and as it did here. Now in this instance, it broke down from a falling top and we had 6 weeks of weakness. This was only 3 weeks of weakness because it was off of a new high, as is this. We are, however, just starting to break that upward trend line. So we could rebound, build a falling top, and then break downward. And that would be a pretty strong sign that there is more weakness coming. That may play out in September. Now, remember, in September, it's widely expected that the US Federal Reserve is going to lower interest rates. In fact, if we look at this diagram here, which is from the CBOE website, the prediction is that there's a 72.5% chance that we will see a quarter point cut and a 27.5% chance we will see 0.5% cut. Now, if you looked at this last week, it was more like 90% of a quarter point cut and only like a 4% chance of a 0.5 point cut. And then there was some chance of no cut at all in September. But because we had this weak PMI number, jobs number, this end of this week, that is making investors a lot more concerned that a recession is coming and that there is more of a need to lower interest rates. So you have this two things going on. You've got concern about recession, which is perhaps why the market sold off at the end of this week, but you also have the potential for a rate decrease, which is positive for stocks, more so for the broader market than it is for the large cap tech stocks. So I think what we have right now is the continuation of that rotation out of tech stocks that we've talked about here for a couple of weeks and moving into the broader market. However, I also think that When you see headlines that the market is going down a lot, it makes people nervous, especially going into the fall when we tend to get market crashes. So the outcome then is I want you to be pretty careful with buying anything right now. And in fact, there may be good trades going long of volatility. Now, we always watch the charts, but I think that's prudent right now. Now, we're going to get into my scoring and everything on the markets. Let's move on from the S&P to the NASDAQ market. And here you see the NASDAQ has had a more significant pullback from the highs. We're down, I think, into corrective territory. I think it's down 10% or so. And we've broken this falling top. But again, the daily chart can be a bit deceptive. I always think it's best to look at the weekly chart and just draw lines across the bottom. So we have this trend line, which we are still quite a ways above, and we have this one, which has been broken. So I think it's a reasonable expectation that we fall to that trend line, which support in around 420, maybe just below 420 before the market is able to make a good bounce. Now, let's move on to the small cap market, IWM. And here we see that this market was looking pretty good. It had broken out from an ascending triangle. It gave back some of those gains Thursday and Friday, but it's still a relatively solid chart because the trend is still intact. We had a breakout. It's very common to get a pullback after the breakout, and then I think we can resume the upward trend again as the market starts to think about the potential for lower rates. I'm going to show you a chart of the bond market in just a moment and how that is really predicting that rates are likely to turn, and that should be supportive for these broader market stocks. Let's move on to the Toronto Stock Exchange. Let's look right at the 3-year weekly. You can see the trend is up. Yes, there was some weakness there, but the trend line is still intact. We had a pullback, a break. It's very normal to get a pullback, and hopefully this resumes its upward trend. Looking at the 1-month chart, yeah, sharp pullback. It's really a neutral chart because we're essentially going sideways there. Let's take a look at gold, which is actually looking decent. You can see on the daily time frame we have rising bottoms. We're starting to tickle through this resistance. Looking at the 3-year chart, it's in an upward trend, so gold is solid, and I think the mining sector, the precious metals sector, is a place to perhaps hide out if you think some market weakness is coming. Oil, a little different story there. You can see oil has been moving lower for the past month. If we go to the 1-month chart, that becomes even more obvious. So there is definitely the sellers in control of oil, but the longer term picture is still okay because we still have rising bottoms. I think we should see oil bounce. Again, if there's a drop in interest rates, that's supportive for the economy. That makes oil demand stronger, and that might be the supporting factor for oil. Perhaps it gets down a little bit more before it makes that bounce. All right, let's take a look at the currencies now. US dollar is essentially sideways, but you can see the weakness here at the end of the week, and that corresponds to strength in the bond market, which means interest rates coming down. So they're all interrelated. Makes a lot of sense why the US dollar would be moving down there. If we look at the Bitcoin market, a lot of volatility this week. You can see the choppiness of this market. It's really trendless, hard to trade because of that lack of trend. Looking at the 3-year chart, it is toppy. It's been toppy for a while, and it's actually building this negative pattern. I have some concerns about Bitcoin. You can see the sentiment stock score only 37. Reminder, you can get the stock scores for any stock traded in North America. Just go to the website. It's free, stockscores.com. You just punch in the symbol, and you can see what the stock scores are for whatever stocks you own. There's also a little article on the website in the trader training area that explains how the stock scores work. All right, last chart I want to look at is TLT. This is the bond market, and this is the most important chart of the week. So here we have resistance, rising bottoms, breaking out. That points to higher prices in the bond market, which means lower yields means the market predicting interest rates are going to come back. And that goes back to that chart I showed you earlier from the CBOE predicting that interest rates are going to be lowered at the next Fed meeting. Well, here's the trend line. We have rising bottoms, and we broke to the upside from a rising bottom and breaking the downward trend line. That's a very strong signal that the bond market is rising, interest rates are falling. That'll be supportive in the long term. It takes a while, but in the long term, supportive for the economy, supportive for the broader market of stocks. I think we're going to continue to see money come out of the high-flying tech sector and rotate into the broader market. In the short term, probably get more volatility, perhaps the gold mining area a place to hide. So my ratings then, bearish in the short term for US large cap and NASDAQ, and neutral long term. A little better for US small cap and Canadian stocks, neutral in the short term and bullish long term. The same for gold. Oil, bearish short term, neutral long term. US dollar, bearish short term, neutral long term. Bitcoin, neutral on both time frames, and bonds now bullish on both time frames. All right, at the top of the video, I said we would look at a swing trading strategy called, I call it an Alpha Echo. The reason it's called Alpha Echo is it's a strategy where we look for stocks that have alpha volume. They're trading abnormal volume. They come alive, something's going on. Inevitably, after that happens for a few days, even sometimes a couple of weeks, those stocks will quiet down, but they'll stay up from where they were when they first started the abnormal gains. And what I love to do is find these abnormal stocks, wait for them to quiet down, and then look for my action candle indicator to fire, indicating that money is flowing back into the stock. So here is the chart of SERV, and let's just walk through these phases here. This was the original alpha. You can see the volume on July 19th and July 22nd, very abnormal, and then the stock got quiet. And then it broke here from a rising bottom, and the fact that there's a pink and yellow dot on that candle tells us that the volume traded and the price action was abnormal. And that telegraphs that the buyers are coming back after taking a little break. So that was the signal for a buy. It did that again the next day, and it did it again the next day after that. And from there, from the 25th, moving from $10 to $24 in 3 days before a sell signal right there on the break of the upward trend line at just under $20. So a really nice trade in a relatively quiet summer market. That's a swing trade, relying on the action candle indicator. You can learn more about that at Stockscores.com in the trader training area of the website. And again, make sure you subscribe to the website. There's a free newsletter that goes out every week. Make sure you're subscribed to this YouTube channel because I'm doing these videos, 1 or 2, sometimes 3 a week. They're all free, great knowledge. I hope you've enjoyed it. If so, click on the like button. And as always, trade well.